What if your life insurance policy could pay you while you're still breathing? And what if adding that feature quietly sabotaged the retirement vehicle you were counting on? We're talking about whole life insurance riders, the fine print nobody explains until it's too late, and the decisions that can make a $60,000 policy feel like a $60 mistake. Let's back up and talk about what a rider actually is, because the industry loves dressing up simple concepts in expensive suits. A rider is essentially a contractual add-on to your base whole life policy, an amendment that modifies what the policy does, when it pays, and how much it costs you along the way. The accelerated death benefit rider is the one carriers love to advertise. And honestly, it sounds almost too good. Access your death benefit early if you're diagnosed with a terminal illness. But here's the quiet truth they gloss over. You're not getting extra money. You're borrowing against the benefit your family was supposed to receive, often with fees and interest baked right in. For older buyers, think late 50s to early 70s. The accelerated death benefit rider is frequently included at no additional premium, which changes the math considerably. When it costs you nothing and provides genuine liquidity in a health crisis, that's one of the rare moments where the insurance industry gives you something without picking your pocket first. Now, the chronic and critical illness riders are where things get genuinely complicated, because these sound identical to accelerated benefit riders, but operate on completely different triggers and payout structures. A chronic illness rider might require that you cannot perform 2 of 6 activities of daily living: bathing, eating, dressing, while a critical illness rider pays a lump sum upon diagnosis of specific conditions like cancer, heart attack, or stroke. The premium impact of stacking chronic or critical illness riders onto a whole life policy can suppress cash value growth by anywhere from 8 to 15% annually, depending on the carrier and your age at issue. Think of your cash value like a garden. The base policy is the soil and sunlight. But every rider you add is another plant competing for the same nutrients. And eventually, something stops growing the way you planned. Waiver of premium is the rider that gets the least attention, but arguably deserves the most from older buyers entering their peak earning to retirement transition years. If you become disabled and can no longer work, this rider keeps the policy in force without requiring you to continue paying premiums. Meaning, the retirement asset you've been building doesn't evaporate the moment your income does. Here's where the irony hits hard. The buyers who need waiver of premium, the most people in their late 50s with physical jobs, inconsistent income, or pre-existing conditions are often the ones quoted the highest surcharges for it, sometimes adding 10 to 20% to the annual base premium. The system charges you most for the protection you need most, which is either poetic or predatory, depending on your mood. Historical data from the life insurance industry shows that fewer than 30% of whole life policyholders ever utilize their riders in a meaningful way, yet those riders collectively generate billions in premium revenue annually. The lesson from this isn't that riders are always scams, it's that most people buy them emotionally and evaluate them never, which is the exact opposite of how a retirement planning tool should be managed. For retirement planning specifically, the core question you need to ask is whether the rider enhances or competes with the cash value accumulation that makes whole life worth owning in the first place. If a rider costs you $150 per month in additional premium, but reduces your net cash value growth by $200 per month, you haven't bought protection, you've bought an expensive illusion of it. The riders most worth considering for older buyers are the no-cost or low-cost accelerated death benefit, the waiver of premium if your health qualifies you for reasonable rates, and potentially a paid-up additions rider that accelerates cash value rather than extracting it. The riders least worth it for older buyers are typically return of premium riders, which are extraordinarily expensive, and long-term care conversion riders that duplicate coverage you should have purchased separately years ago. Common misconceptions abound here, and the biggest one is that more riders equal more protection, when in reality, more riders often equal more cost, more complexity, and slower growth in the asset you're actually relying on. A whole life policy stripped down to its most essential riders and funded aggressively is almost always a more powerful retirement tool than one dressed up with every optional feature the agent was trained to upsell. The disciplined approach is straightforward even if it isn't exciting. Review every rider's actual cost. Model the cash value impact over 10 and 20-year horizons, and keep only the ones that provide benefits. You cannot replicate more cheaply elsewhere. Strategy beats conviction every time. Position sizing beats enthusiasm. And a boring policy you actually understand beats a feature-rich one that surprises you at 68 years old. At its core, whole life insurance is a long game, and the riders you choose in year 1 are contracts you're living with in year 30. So the philosophy has to be precision over abundance, clarity over complexity, and process over the feeling that more is always better. We are comfortable with whatever outcome a well-built policy delivers precisely because we built it rationally, not reactively. Whether you're evaluating life insurance as part of a larger retirement strategy or just starting to ask these questions for the first time, check out our links in the description below. We can help you get started, whether in real estate investing, home contracting work, or finding the right lenders for your situation.